Julie, I just came in from about 3 straight weeks on the road, spending my time with financial advisors, financial professionals, their clients, you name it. And I'll tell you, I can't remember a time in my 30 plus year career when things have been so up in the air, especially about fixed income markets. I mean, these are the markets that are supposed to provide stability. And throughout 2022, they've been nothing but a source of frustration, volatility, and that word uncertainty. I don't know if you felt the same.
John, I've experienced the same thing. In fact, in the conversations that I'm having with financial professionals, it feels as if they're about ready to abandon the whole category of fixed income and just look forward. And I feel like there's an opportunity to break this down a little bit today.
I think when we hear the term capitulation, a lot of us know exactly what it means in the equity markets, but it's sure been feeling like we've been getting closer to that in the fixed income markets.
Well, I think there's no better time than to have Amar Reganti with us to break down some of his thoughts, philosophy, and look at the opportunities that lie ahead as it pertains to fixed income. Today, we're joined by Amar Reganti, Managing Director at Wellington Management and Fixed Income Strategist for Hartford Funds. As an investment director in investment products and strategies, Amar works closely with investors to help ensure the integrity of their fixed income investment approaches. This includes meeting regularly with fixed income investment teams and overseeing portfolio positioning, performance, and risk exposures, as well as developing new products and client solutions and managing business issues such as capacity, fees, and guidelines. He also meets with clients, prospects, and consultants to communicate Wellington Management's investment philosophy, strategy, positioning, and performance. Prior to joining Wellington Management in 2018, he worked as a strategist at Grantham, Mayo, Van Otterloo on both fixed income and asset allocation strategies. Previously, he served as the Deputy Director of the Office of Debt Management at the U.S. Treasury Department. He also held roles in fixed income markets as an investment-grade portfolio manager at UBS Global Asset Management, a derivatives solution strategist at Merrill Lynch, and a credit analyst at UBS Investment Bank. He has an MBA from the University of Chicago Booth School of Business, a Master of Science in European Political Economy from the London School of Economics and Political Science, and a Bachelor of Arts from Vassar College.
I'm really looking forward to our listeners getting to hear the conversation that we recently had with Amar about his views of fixed income and where we go from here. Hi, I'm John.
And I'm Julie.
We're the hosts of the Hartford Funds Human-Centric Investing Podcast.
Every other week, we're talking with inspiring thought leaders to hear their best ideas for how you can transform your relationships with your clients.
Let's go.
Amar, welcome to the Human-Centric Investing Podcast today. Thanks for being here with us.
Thanks for having me.
Amar, thanks for being with us. And my first question for you is that as I've traveled with financial advisors over the past several months, probably the thing I hear most about these markets is that there's no place to hide, right? Fixed income was supposed to be our bastion in the storm, if you will. Can you share with us a little bit about what's happened? And as an advisor, how would you try to explain that to your clients, especially clients who thought that, that they were allocated in a somewhat of a conservative position?
That's a great question. Generally speaking, over long periods of time and for the long-term investor, fixed income, can be that diversifier to your overall allocation. But there are, and historically there have been, narrow periods of time where you have these bursts of inflation, and many fixed income asset classes don't do well, nor do equities during those narrow periods of time. So the challenge, of course, then is the diversification feature declines. But really, I think what's important is to try to understand whether they think that that burst of inflation is a permanent or structural feature, or is going to continue higher, or they think it's going to normalize or come lower in the next several months to a year. And in that case, fixed income resumes its really critical role in a portfolio. And this isn't to overemphasize this, but there's also fixed income strategies that have been able to navigate this period of turbulence much better than other ones. So, for example, a global bond allocation that really looks at relative value between interest rates and currencies, like that has been one that can navigate these periods in a way that is probably a little bit more within the expectation range of the advisors you've been talking to.
Amar, you just started to talk about the different types of fixed income. And it seems like when we talk about fixed income, oftentimes we lump it all together into one bucket. And could we maybe, just since we're kicking things off today, start to unpack and define some of the different types and areas? And as you define those for us, are there any that are looking more attractive now as we look forward?
Yeah, it's always amazing, as we all know that people can have a long discussion about the different types of equities out there and the different type of equity strategies, but fixed income is often lumped into just sort of one type of asset class. When the reality is that it's an extremely diversified diversified sector, and within it are lots of subsectors and strategies that perform in really different ways in different parts of the cycle. So just from our perspective, we've often thought of fixed income as something that can provide income. It can provide risk diversification in some cases. It can provide tax relief depending upon if you're in tax exempt or taxable municipal bonds. So it can provide a great deal of different things, but I think oftentimes people just treat it as like this one type of asset class. And within the fixed income world, there are a number of sub-asset classes and approaches that make a lot of sense for people to take a look at. I mentioned approaches via global bonds, where you can look across the entire fixed income space around the world and decide whether or not, or your manager or strategist can decide whether or not the bonds of one particular country look better relative to the bonds of another country. And by looking at the differences between these types of interest rate curves or foreign exchange, it's actually a way of being able to take advantage of the volatility that's currently plaguing markets. And you've seen strategies that can do that. In other cases, the strategies that a lot of people are familiar with, core plus, or municipal bond strategies, have traditionally existed to be both liquid and a form of capital preservation, and in the case of municipal bonds, a way of receiving tax-exempt income. Those are also utilized in times when there's recessions, right? They're there to help protect you or your allocation in periods of deflation, in periods of flight to quality, or when people are sort of rushing to the safety of higher quality bonds. And then, you can look at the credit markets, where there's a large spectrum of different types of issuers, from emerging market countries to high yield credit to high quality investment grade corporates, all of which would provide yield and income that, I think, a lot of advisors might find interesting. And remember, just 2 or 3 short years ago, though it probably feels like a long time now, those interest rates and yields were at very, very low levels, and people were struggling for ways to really look at fixed income as a source of continuing income in their portfolios. Now there's a pretty large opportunity set that's evolved, and it really bears taking a look at all the different facets and features.
So, Mar, right now in the fixed income markets, I mean, a lot of times you hear, especially when inflation is low, you start hearing about people theorizing about the mandates of the Federal Reserve, right? Is it full employment? Is it inflation? Would you say that this market is really solely focused right now on inflation, the causes of inflation, how to combat inflation? Is that really the key to understanding across just about any fixed income class what's going on right now? And second part of that question is, if you were sitting on the Fed board, what would you be thinking right now about inflation?
So, as you mentioned, the Federal Reserve has a dual mandate. One is focused on inflation, and the other is focused on employment. And sometimes those goals can be at odds with each other. So the Fed has to undertake a balancing act. Prior to this year, the Fed really was laser focused on making sure that there was a full employment recovery. And in a view that I think the data has changed, was that the inflation that they were experiencing at the time would be rather short-lived. So once the end of 2021 came about, and the Federal Reserve sort of took stock, had realized that employment had gotten back to or near the levels that we were at prior to the pandemic, it really pivoted very quickly into focusing on its inflation mandate, and of course rapidly started raising rates in order to combat inflation and to try to bring about what I would call a looser set of financial conditions, tighter set of financial conditions. I apologize. That would slow the economy enough that it would cool inflation. Look, if I was, sitting on the Fed board, I've of course, as mandated, I would have to think about inflation, but of course, I would proceed relatively cautiously and tighten financial conditions via interest rate hikes. But then I would certainly pause and think to see how long it took for that to pass through. As we know, and as we've discovered, monetary policy operates with significant lags. So what you're doing today might not show up for months into markets. And additionally, whether or not this Fed, I guess, likes it, to some degree, because of the size of the U.S. economy, the preponderance of its capital markets, and the role of the dollar as the reserve currency in the world, central bank policy in the United States has ripple effects into the rest of the world. And that ripple effects can be destabilizing. It can damage growth around the world. And I think, we always have to understand that stuff can easily spill over into our own economic conditions. And the Fed, needs to be hyper cognizant of that, whether or not it's sort of narrowly within the mandate that I just described earlier.
Amar, a moment ago, you mentioned yield to worst. For financial advisors not familiar with that terminology, how would you further describe yield to worst? What does that mean?
Yeah, I'm going to paraphrase here because this isn't a textbook definition, but it's a term that's used among fixed income professionals, really as a way of doing an apples to apples comparison across different types of fixed income securities. It really is about like the lowest possible yield, excluding default, that a bond can have, given where it's trading in dollar price and where its secondary yield is trading on the bond market. So that's how we would look across a number of different bonds and compare what the yield to worst are.
You talk about a ripple effect, Amar, and obviously there's been a lot of news about the UK markets. And could you talk us through a little bit about sort of what happened there and how does that impact what's happening in the US, if at all, and maybe how our regulators are thinking about things as we look forward?
Yeah, so the UK is, I think, a really interesting example of what happens when you make rapid, almost violent turns in monetary policy. So over the course of this last year, interest rates in the United States rose rapidly, and they rose in the European Union and in the UK as well, both sort of in sympathy with what was happening with central bank policy, global inflation conditions, and so on. And that can be expected to happen. But what happened within the United Kingdom is that there was a rapid rise in rates over that period of time. And many UK pension entities did asset liability matching, right? They had a sense on their liability side that they had the sort of maturity of their liabilities, effectively when they're going to be paying out to their participants. And they matched that on the asset side. And oftentimes how they would match it is by receiving fixed rates. And they would do this via, the derivative markets, either in swaps or in futures. And that comes off as a almost like a bad set of words, but that was literally them trying to balance their assets and liabilities and using a number of financial instruments to do that. The challenge is that when interest rates go up really, really quickly, they have one positive impact for the UK pensions, which is that their liabilities shrink because they're discounting those liabilities by this higher interest rate, which means they get smaller. But the problem, of course, is that they were on their asset side of their balance sheet, they were actually receiving fixed rates via derivatives. And what happens in derivatives is if there's a change in the positioning where the position moves against you, as it does if rates rise and you hold a fixed rate instrument, they had to post collateral to sort of make up for that change. And it was a rapid rise in rates, and it happened very quickly. So they had to post a substantial amount of collateral. And what that leads to often is a sale of assets in order to do that. So they sold, a lot of liquid assets. And you can, we heard this and saw this via the popular press, the financial press, and statements by the UK regulatory community. And of course, as they're selling those assets, they're adding pressure in upward movements in rates. Now, this didn't happen by itself. There was a catalyst to this, which was the UK government released what was called the mini budget. And the mini budget effectively was calling for a set of tax cuts in order to spur growth. But as we all know, the UK is facing a substantial set of inflationary conditions. So when you're having inflation and your government budget program is what they would call pro-growth, which involves tax cuts and probably more deficit spending, that really shocked the UK interest rate markets and gilt markets, which is the sovereign bonds, upward and higher. And that fed, this cycle that it's slowly been happening, but really was the catalyst that drove things sharply higher. Then it caused all of these UK pensions to have to post collateral, and that caused a sale of assets. And then again, that drove things upward. Now, the UK regulators and the Bank of England has attempted to intervene. And again, that was somewhat effective. Then they said they weren't going to do it. And that caused a bit more instability in the market. And finally, I believe as of, fairly recently, the newly appointed Chancellor of the Exchequer, Jeremy Hunt, is reversing the government's policies. And that's bringing some stability to markets. And this was a long way of saying that rapid changes in rates can often be very destabilizing events, not just in fixed income, but across all capital markets.
So, Amar, I know, about a year ago, everybody was talking about within the fixed income portion of your portfolio, duration, right? And where should duration be? Should we be shortening? Should we be lengthening? Given what we've been through and what may lie ahead, what would you counsel people about right now concerning duration? Would you be adding? Would you still be pulling back? I know, a lot of us may be kind of thinking about a more defensive posture, but what would you say?
Look, it's, being a holder of duration, it's been a very challenging time for a lot of individual investors and market participants. But one of the things that you have to really think about as you hold duration is like, what are you using it for? And what it's normally utilized for is if there's some type of deflationary shock in the economy, or if there's a flight to quality, that interest rate duration has traditionally and historically served as an offset. Obviously, this year, because we've had a significant amount of inflation, that duration hasn't been helpful. But if you listen to what the Federal Reserve is saying, what Chairman Powell is communicating, is that the Fed is attempting to tighten financial conditions. The Federal Reserve works primarily through a markets-based channel. They're trying to, by raising interest rates and the process of quantitative tightening, they're trying to slow down and candidly probably lower portions of the capital markets. And ideally, that will spill over into the real economy and effectively loosen the job market, given how tight it is, and slow down aggregate demand enough that inflation won't be as much of a problem. What the Fed is telegraphing is that it's determined to bring down inflation and it's determined to slow down the economy. This is exactly sort of the usage, I think, of at least duration for in your overall portfolio allocation. It's there when things are moving from fast or intermediate to a slower level. Like that's how duration can be helpful in your portfolio. Now, it's very hard to say now's the perfect moment, or last week was, or next week is. But what my opinion has been that you should slowly be adding duration to your portfolio. And several years ago, that was actually almost a painful thing to consider because there was an opportunity cost in that. Like interest rates were really low. Yield to worst were very low as well. You weren't generating much income off of your fixed income portfolio. So there was a significant opportunity cost to adding, an additional marginal dollar into your bond portfolio. That has changed now. The opportunity cost is significantly lower. In fact, I would say it's reversed, right? You're actually now getting paid to add duration, to add fixed income allocations into your overall portfolio, and you're being paid a significant sum based on the last several years of data, which is in the highest quality bonds. You're getting paid, mid to single digits on a yield to worst basis, and in what I would call a little bit more risk-seeking parts of the bond market, you're getting paid up to double digits or very close to them on a yield to worst basis. That means that you're not waiting around for returns. Those returns are theoretically accruing, like as you're holding those bonds. So I think of it as actually a really attractive time to think about adding duration and think about expanding the overall share of fixed income you have in your allocation.
Amar, just so that we're all on the same page with our listeners, when you say duration, how are you defining that in your mind so that we're all on the same page?
Sure. Well, duration is traditionally thought of as the sensitivity of the price of a bond to changes in interest rates. Now, generally speaking, the more years to maturity there is on a bond, the longer that duration is. Meaning, there's more cash flows involved, and because of that, it's sensitive to changes in interest rates a lot more than a bond that was, for example, going to mature next year, because you just know it's going to mature next year. But longer maturity bonds tend to have more duration sensitivity overall.
We've talked about that these are just unprecedented times, and I know that word is at risk of being overutilized. And I'm sure, Amar, if you counted the number of times in a day you've said that, it's probably too many to tally. But if I think about financial professionals engaging with their clients, this is such an emotional time, and the phones are ringing and the emails are coming in, and people are seeing the volatility in the markets, and their bar charts are shrinking on their statements. How, from a financial professional perspective, what are some talking points, or what would be the story or the rationale that we could share with them to just help clients continue to understand and have some perspective as they look forward as it pertains to fixed income?
Yeah. Look, I think it's good to take this sort of in the overall context of maybe, let's say, the last decade even, or just slightly longer than that. This is, from our perspective, this is not 2008 and 2009. And if you were in the markets back then, or even if you weren't in the markets back then, there was really almost an existential risk that was affecting U.S. capital markets. At the time, it was very unclear which financial institutions were solvent or not. There were at that time there was pretty active talk of pulling money out of bank accounts if it went above the FDIC threshold. So the basic functioning of capital markets was extraordinarily problematic. And when we actually think about the full recovery that took place in financial markets, while financial markets might have recovered relatively quickly in the 2 to 3 years following the GFC, the real economy took a long time to heal. Indeed, in some measures of employment, we never really got back to it till almost a full decade after the end of the crisis. That is not the situation that we're facing from our perspective. This is, we're not facing what I would call an existential risk to capital markets because of near-term inflation or the Fed hiking. What we're facing is a really strong economy that has a very tight labor market, where the demand is outstripping the supply of the economy to satisfy, society's demand for goods and services. And that's partly what's causing the inflation. I mean, obviously, another part of it is energy and the crisis we see in Europe. But the part I've described about just the demand conditions within the economy, where you have a strong, like a consumer that has significant savings, where you have corporate balance sheets that are generally in good shape, where you have state and local governments that have a lot of funds to deploy and are not in the dire situation they were in 2009 and 2010. You're talking about an economy that's in really good shape, and because of that is feeding into core inflation. Like, it's that demand that is driving the Fed's requirement almost to pivot and tighten interest rate policy. That's absolutely not the case we saw in 08 and 09. So what we're seeing now is, while it's challenging to look at capital market returns, it's in the context of a relatively strong economy, and that's a good thing, because over time, if you think the Fed is actually going to cool inflation and slow down the economy, it means there's a much, much smaller chance of something like turning into a crisis-like situation. And that even if the economy does slow, the ability for it to come back is much better than it was where we're sitting in 2008, 2009. And all of that allows, like from a capital markets perspective, the ability to invest with probably a lot greater confidence than you could in 08 and 09, when you were really concerned about whether the system itself could function without active intervention by the policymaking community.
So, Amar, I want to revisit a topic that Julie asked you about earlier, which is relative valuations within the fixed income market overall. So, when I know from speaking with you, you're moderately bullish on fixed income. So maybe like asking which one of your children you love the most, right? But maybe I shouldn't put it that way. Maybe we should talk about which one of our kids is best behaved when things go a little crazy, right? So I guess in that context, as you look at different sectors, you just mentioned munis, but I'm interested, like during periods like this, are there areas of the fixed income market that you would give a nod to versus others, that you would kind of lean to slightly versus others at this point in the cycle?
Yeah, so let's just say from a starting point, and I do think this is the case, that you want to grow the share of fixed income you have in your overall allocation. Well, first and foremost, if you're trying to protect yourself from a slowing economy or recessionary conditions down the line, there are ways you can do that. You can look at active strategies that are benchmarked to the Bloomberg Aggregate Index, which is sort of the widely used US dollar index of high quality fixed income. And that's generally a mixture of investment grade corporate securities, agency MBS, which you may or may not know is under the conservatorship, the majority of it, of the US Treasury, and then the U.S. Treasury securities market. And this sort of blended index is considered sort of the proxy for investing in high quality fixed income in the U.S. market. And that is sort of like the starting point. If you're building a sandwich, that's like the bread, right? It's very standard, and we believe it offers in recessionary conditions a better way to help protect your overall allocation. But this time period is not exactly the most normal one, and we talked about this. It's possible inflation remains a little bit stickier than we expect. There's tons of geopolitical risk that we see outside our, like in Europe and in Asia, and like that we don't, and we've said this, we don't think this is going away necessarily in the near term either. And then additionally, all of this sort of feeds into volatility that just sort of permeates markets, right? And a really interesting way of taking advantage of that volatility is through a global bond strategy. And not all global bond strategies are really created the same, right? There's some that just go buy bonds from abroad and sort of have those. And I don't think that's as useful to a US based investor. But there are global bond strategies that actively will be, long one interest rate and short another interest rate, or long one currency versus another currency. And the point of that is to exploit differentials, both from valuation or where we are in the cycle between these. And those over the course pre-COVID, I think they got relatively a little bit sleepy because there wasn't a ton of volatility in markets. But in volatile markets, those type of strategies can do, particularly well. And I think that's actually a very forward-leaning way of saying I think the world's going to be a little bit bouncy, and this is one way of dealing with that. I mentioned munis, and it's kind of extraordinary to know if you look at the muni market and compare it to where we were following the financial crisis, when state and local governments had to do layoffs and cut back on services. That's absolutely not the case right now. They're overall as a sector, they're in really good shape. And when you're thinking from a tax exempt perspective, I think it's very interesting that you can now start receiving yields that will actually make you take a look again at what used to be a relatively quiet asset class. So that I think of that as the high quality sort of bucket. Now, if you're growing the share of your fixed income allocation, and let's say you're funding it from equities, and you say, well, I don't want to be purely more on the mitigation side or on things on just the highest quality side, because I do want some substantial upside or look to get better returns than just mid-single digit yield to worse. Well, then you should look to sort of more diversified credit strategies, right? Like, and that allows you to look around the entire credit spectrum and find the bonds or sectors that are priced to deliver you over some course of time, like robust expected returns. But remember, like as you do credit, and the more you move down in the credit scale, like the more volatile that allocation can be. But now you're at least getting compensated for that volatility. And then finally, even on just the shorter maturity or shorter duration type of allocation, you don't have to not completely abandon that. You're getting paid somewhat well too, given how high front end interest rates have risen. So to me, as you said, it's hard to pick there are just so many different spots now that I think are attractive in fixed income, but you can now build an allocation that is really much more tailored toward your needs, your risk appetite, and your concerns over the next year or two than you could 2 or 3 years ago, where you simply had too big of an opportunity cost oftentimes to make that allocation.
So if we think about the actual implementation, will you share your thoughts and philosophies around individual bonds versus bond funds and some of your thoughts there as we think about the future?
Sure. Look, I think bond funds, for a number of reasons, are something that is probably more useful to an end asset owner than individual bonds. Sure, you can buy an individual bond here and there, and there's absolutely nothing wrong with that. But the challenges are, unless it's like a U.S. government security, you need to go through and do the underlying credit work. Those credit details can change. Sometimes that bond on secondary markets could have reached what we'd call like its full valuation, meaning there's not much more room for either the dollar price to appreciate, or there's other bonds of equal quality or equivalent quality that might be more attractive or priced more attractively, and that ability to rotate, to look across the universe that you've decided you need to find the right bonds, to do the credit analysis on them, to maintain that credit analysis, and then to sell them as appropriate, and buy new bonds, like that comes from a fund, right? And it's the job of that fund to put together those portfolios, to worry, about which bonds aren't priced for the outcomes that they want, and then to obviously get rid of those and cycle into bonds that are. It's very hard to do that in static bond allocations, right? You buy it, things can change, and you sort of hold on to it, and there's opportunities that you miss, and you don't effectively have the dynamism, which I think is important both from a return perspective and a risk management perspective, that I think is critical to successful bond investing.
Amar, recently we did an informal survey on one of the webinars that we hold on a regular basis, and we asked financial advisors whether they expected in 2023 that we would experience a recession. And the vast majority agreed that they believed we would experience a recession. Now, we didn't discuss severity. We didn't discuss, some would say we're already in recession, so on and so forth. But, as you read the headlines just over the past several weeks, I think based on our discussion earlier about the Fed has just about come out and said, look, we are more willing to make a mistake to control inflation than we are making a mistake worried about implications for recession, which signaled to a lot of people. And you mentioned before the lag at which some of these interest rates can affect the economy. Let's play out a scenario. And let's say that somewhere in the midst of 2023, we're in a recession, and let's say a fairly severe recession. How would you expect fixed income to act in that scenario?
Yeah. So, look, I think those concerns that people have on the Fed's communications, that sounds like a reasonable concern, right? When the Federal Reserve is in this tightening process, and they've really focused on the inflation portion of their mandate. Like history would tell you that there's a higher probability of inflation. So in that case, right, like this is where fixed income, particularly high quality fixed income, will be there to act, from our perspective, as a capital preservation vehicle as well as a return vehicle. I mean, and it happens in two ways, right? If you have the right collection of bonds, if you've done the credit work, you keep any kind of what I would call defaults and impairments to a minimum. And then secondly, if the Fed is in the process of inadvertently engineering a recession, that means rates will have to come lower. It likely means that both real and nominal interest rates would decline under that scenario. And if that's the case, there are capital gains valuations in bonds, and I say this tongue in cheek, but rates go down, bond prices go up, but that is effectively how the math of fixed income as a starting point at least works. So in that case, these bonds, like just say hypothetically, if you owned a whole collection of bonds that were yielding 4 or 5%, and all of a sudden, the fair value for those maturities was now down to 2 or 3%. Well, that the net present value of that differential in interest rate shows up in the price, right? And if you've been lucky enough to make that allocation decision, that's how you'd get capital appreciation out of it. So but what's really important here is that it has to happen before that happens, right? After the recession or after a recession, you're buying bonds that are already pricing in slow growth and low inflation and have pretty low yields. And yes, I still think at that point there can be usefulness to you in that portfolio, but it becomes less useful than you would think of if you're gradually adding while rates are at these from at least a historical perspective, these near-term highs. So that's why it's hard to call exact. If you're worried about that, if that's your concern, the way to think about allocating is to begin that process of allocating to high-quality fixed income, and that includes duration in that as well. And it includes duration, includes possibly thinking about a global allocation, it includes thinking about municipal securities, all of those depending on your needs. And that is, there to help you sort of navigate what a 2023 downturn would look like, as we talked about.
So, Amar, I guess listening to what you said there, I think, when interest rates are calm and fixed income markets are doing what they're supposed to, we often look at the equity markets and we tell our clients that the markets are forward looking, and we mean the equity market is forward looking, right? So by the time you're ready to invest, the market has probably already moved. It sounds like you're telling us the bond market may be even more plain spoken in terms of being a forward looking predictor of future economic activity, right?
Yeah, and look, and I say this as a fixed income professional, but I've always delineated between the two. Is in a way, the equity market it is, as you notice, yes, it can be forward looking, but it also takes into account almost like the animal spirits of markets, right? The current psychology for risk on or risk off. I always like to think of the fixed income market as much more of a measurement of blood pressure, right? When the economy is running hot, when inflation is hot, the blood pressure, hence the yields, are high. When things are more quiet, where they're more dormant, that tends to come down. Fixed income markets are absolutely, they attempt to be forward-looking as well. And, the reason why we're in an inverted yield curve right now is because that's the market's feedback mechanism saying that at some point in the future, current rates will have to be lower than what they are right now. And that's what that inversion is telling us, right? Just, the commonly held view within fixed income markets is that an inverted yield curve is a forward-looking way of saying at some point monetary policy is too tight and it has to be relaxed and interest rates have to come down. And usually the catalyst for that is some type of, recessionary event. I know equity markets have their own lenses. I don't think, in my view, there's something as elegant as that available necessarily in equity markets, where in fixed income markets, it's sort of available on a screen to take a look at.
Amar, those that know me know that I'm very passionate about teams and communication and how groups of people share information, especially when it's changing so rapidly. And for our financial professionals listening, I'm confident that every single day with things with the volatility and client inquiries, they're navigating their way through this information exchange process amongst their own teams. Do you have any strategies or best practices that you and your team have put into place during these times that you could share with our listeners to help them continue to do the best job that they can, sharing information and making sure that everyone is up to speed and ultimately delivering the client experience that they want to be delivering?
Yeah, I think there's a couple of things that we do that help us. The first is that we are, we pride ourselves on collaboration, right? Which means I might have a view or I might have a set of ideas. And in part, I'd like to think they're well thought out and well researched, but they're also shaped by my own perspectives and background and events that I've worked through. So the more you are able to talk to teammates, colleagues, experts in different fields, the more that you can, decide whether or not you are challenging your own assumptions enough. And additionally, learning about things that you may not have heard of or have talked about in recent time. So I think working in as collaborative an environment as possible is critical. And within that means people need to be able to speak and share ideas and do that in a way that is encouraged. Even though you can be wrong, as anyone can be in anything, but that elevates a conversation. And I know that's something that my team and my firm we really think is part of our culture, but it's not something that comes easily. You have to work at it. You have to push yourself and others to do that and to take part because it's just not something that just happens. So for me, always sort of like kind of checking my assumptions, talking through with other people who have the same and different backgrounds, I think is one of the most critical views of getting out of your own head. Just like getting out of, your own set of thoughts that comes back to the same type of conclusion time and time again. And that doesn't mean you're incorrect or wrong. It just means that, I think there's a better chance of being right when you've put it through a full vetting process.
So, Amar, I know from our previous conversations that you're moderately bullish on fixed income in general. So maybe when I talk to you about different segments of the fixed income market, it'd be like asking, like if somebody asked me which of my kids is my favorite. But maybe while I don't want to choose that, I could tell you which one of my children would be better behaved in uncertain times. And so maybe it's better phrasing it like that as you scan the fixed income landscape. What assets within fixed income would you expect to be better behaved, if we really don't know what's happening going forward?
I don't want to be purely on the mitigation side, but given where yields are in some parts of the credit market, for individuals who are either a bit more risk seeking or seeking to replace some of their riskier equity allocations, there's a pretty interesting opportunity set as well in diversified credit.
So, Amar, to help our audience get inside of Amar's head, we actually have a fun little exercise that we often ask our guests to participate in that we call the lightning round. Now, as opposed to many of the questions we've asked you earlier about technical issues within the fixed income market, I think you'll find these questions a little bit easier. But what we want to do is really hear your top of mind, first impression answers to the questions that Julie and I are going to fire at you. So if you're ready to go.
Okay. This is the more intimidating
Julie. Julie, you want to start?
Absolutely. So Amar, on a scale of 1 to 10, how good of a driver are you?
I'm a 9. I mean, I think I'm really good, but I'm a really careful driver. And maybe that's because I work in fixed income. So yeah.
What is your favorite holiday?
You know what? I think the Christmas time is like my most favorite holiday. Partly because my wife and I actually love going to the theater and seeing the Nutcracker and A Christmas Carol and like everything that comes out during the month of December. So I think we both really enjoy that time of year.
What's your favorite kind of cereal?
Oh, Lucky Charms.
Are you a morning person or a night owl?
A night owl, definitely.
If you had your choice, would you choose cake or pie?
Pie. Um, a way better expression of fruit is my thought.
What do you think is the best age to be?
Wow. I'm going to say, so I'll say in my early 20s, my first boss, when I was a credit analyst, told me my mid 30s would be the absolute best time. And I enjoy everything, but there is something very special in your 30s when you're at this sort of fulcrum point in your career where you feel more confident about the work you do, you feel more established, but like there's you're still young enough that there's multiple sort of ladders up, right? So I think that's a really special time. And people, it's easy to forget. You think about your first job, or you think about where you are now. But that mid 30s years, I think is really, it's extraordinary. I think it's a really fascinating time.
In your opinion, what's the ideal outside temperature?
I would say high 50s, low 60s, but clear, right? So sort of that crisp fall weather, which we're beginning to enjoy here in New England now.
Would you describe yourself as an introvert or an extrovert?
I think I'm an extrovert. I like talking. I think one of the best parts of my job is talking to people, and I know it's primarily about bond markets, but inevitably you get to talk about a lot of other things too.
Well, Amar, we can't tell you how much we appreciated getting to know you personally and professionally today on our Human-Centric Investing podcast. And we hope all of our listeners enjoyed our conversation today with Amar Reganti. We're happy to announce that Amar has been appointed to a newly created position as the fixed income strategist for Hartford Funds. He'll be writing a monthly commentary to help financial professionals titled Fixed Income Observations that you can access at hartfordfunds.com/Amar. Again, thank you so much for being with us today.
Thank you for having me.
Thanks for listening to the Hartford Funds Human-Centric Investing Podcast. If you'd like to tune in for more episodes, don't forget to subscribe wherever you get your podcasts and follow us on LinkedIn, Twitter, or YouTube.
And if you'd like to be a guest and share your best ideas for transforming client relationships, email us at guestbooking@hartfordfunds.com. We'd love to hear from you.
Talk to you soon.